Russia is currently the most sanctioned country in the world. On October 15, 2025, the United Kingdom announced a new wave of sanctions against Russia, a move that sent ripple through global oil and financial market. These sanctions targeting Russian two largest oil companies, Lukoil and Rosneft, and the 44 tankers within the so-called shadow fleet.
Today, the UK government are significantly stepping up the pressure on Russia and Vladimir Putin's war effort. We are introducing targeted sanctions against the two biggest oil companies in Russia, Lukoil and Rosneft.
And now you may wonder why the UK keeps sanctions on Russia again and again. After its invasion against Ukraine, many countries such as the UK, the United States, and the European Union have pulled similar sanctions on Russia. The goal was clear: it is aimed to reduce the Moscow energy revenue that funds its ongoing war effort. However, the UK strategy focused on cutting the Russian access to key maritime services such as insurance, shipping, and financing, rather than banning the oil sales directly. This approach created uncertainty around the delivery of Russian crude oils, although the Russians continue to export oil through alternative routes, mainly to India and China. However, the UK sanctions disrupted transportation network and raised the operational costs. Regarding these sanctions, two financial markets were directly affected. The first one is commodity market, where the oil physically traded, and the second one is derivative market, where the future and option price of oil are bought and sold. Commodity market is a marketplace for buying, selling, and trading new raw material product or primary product, such as crude oils and gold. Meanwhile, derivative market is a place where investors use contracts to hedge risk or speculate on a future price movement. When sanctions create uncertainty, most of traders tend to adjust their expectation and behavior, and that's when things get interesting. Following the UK announcement, Brent crude price rose by roughly 1 to 2%, while Euro crude Russian main export remained discounted. If we take a look at this graph, we can see that the price between Russian and Brent oil are almost equally before 2022. However, after Russia invaded Ukraine, the price gap between Brent and Euro oils became wider and wider. Meanwhile, in future market saw a surge in trading activity as investors rushed to hedge against the price swing. Speculative trading spikes and volatility increased in both Brent and the WTI future. Energy-focused fund and commodity traders become more cautious as forecasting oil price become more increasingly difficult. From financial theory perspective, this event illustrates the concept of risk premium. When market face higher uncertainty like sanction, investors demand greater return to compensate for that risk. In future market, these appear as a high future price compared to the current spot price, reflecting expectation of supply disruption and increase in transportation costs. In the short term, the sanctions create a quick reaction. The traders rush to protect themselves, the volatility spike, and the derivative trade cost is also rose up. For many businesses such as the airline and shipping firm, that means the higher expenses and the less price stability. As for the long term, the repeat Western sanction could reshape how the oil company operate. If the logistic and financial channel remain restricted, traders may move towards non-Western companies such as India or China, where the sanction has lower influence. This shift can fragment the global oil market and make it more harder to regulate. To sum up, the UK sanction has successfully achieved their main goal, tightening the pressure on Russia without causing a major global oil price shock. However, they reveal how the interconnected and sensitive the oil market has become. Moreover, a single policy that targeted the logistic company can now ripple through financial markets such as the commodity market, derivative market, and even the currency market.